second-largest economy is stumbling.
China could be facing an extended economic downturn.
China's economy losing further momentum.
China slowing down.
The U.S. president has described China as a ticking time bomb.
The juggernaut of the Chinese economy is losing steam. The dragon economy, which grew in double digits for more than 2 decades, is struggling to even clock a 5% growth rate. It has big ramifications for the world's second-largest economy and the challenger to the United States. Chinese real estate sector is in deep trouble. And the global slowdown has been harsh on the country's manufacturing sector. The two sectors together account for 56% of the Chinese economy. The state of the Chinese real estate sector is so bad that millions of houses are lying empty, wiping off the wealth of the middle class, which had invested its lifelong savings in these assets. The strategy of fueling GDP growth on the back of the construction sector has backfired for Xi Jinping's government. Xi has got several things wrong since the COVID pandemic. His zero-tolerance policy to control COVID spread for 3 years has backfired. Unlike the United States, the Chinese government did not provide substantial subsidies to households and enterprises during the pandemic, leading to a notable decline in demand. This absence of support measures has had a profound impact on the overall economic landscape. In June 2023, China witnessed a record high in the jobless rate for individuals aged 16 to 24 in urban areas, surpassing 20%. Following this, China ceased the release of youth unemployment figures, which are considered a crucial indicator of the country's economic slowdown. What would also worry Chinese policymakers is the slowdown in factory activity. In its heyday, the economy thrived on export-oriented manufacturing. However, the current year has witnessed a slowdown in both export and manufacturing sectors. The global demand for Chinese-made goods has slumped due to the impact of the coronavirus pandemic and the ongoing trade dispute with the United States. Its exports have fallen for 6 months on the trot this year. Investors have sharply reacted to the developments. For the first time in 25 years, FDI fell into negative territory. Foreign investors have also fled its stock markets. Due to the slowdown in the economy, household wealth has shrunk, threatening a further decline in the consumption of goods and services. Given the prevailing factors affecting the economy, is it justifiable to proclaim the end of China's growth story? Several experts argue that despite a significant downturn in the real estate sector, the country continues to achieve a growth rate close to 5%, indicating its resilience. Notably, China's merchandise trade surplus has also continued to expand, highlighting the strength of its export sector. These observations challenge the notion of a complete demise of China's growth narrative. Despite obstacles, the economy demonstrates noteworthy indicators of stability and potential for sustained growth. As uncertainties loom over the Chinese economy, it raises questions about the potential implications for India. India, aspiring to become a global manufacturing hub akin to China, has successfully attracted major players like Apple and Foxconn to establish factories, propelling industrial growth. The China Plus One strategy has also benefited Indian stock markets, witnessing record inflows from foreign investors in 2023, driving the Sensex and Nifty to unprecedented heights. However, there is still ground to cover. India faces competition from Vietnam and Mexico as firms seek to diversify their supply chains. The future outcome will heavily rely on India's ability to further develop its manufacturing sector and bolster exports in the coming year, with hopes that the Chinese economy continues to slow down.